Hello, in today's video we're going to be looking at the new SPX daily key levels version 2.0 indicator from Day Trading GPS. So today is Friday, September 19th, 2025, and we're looking at a 2-minute chart of the CBOE SPX index. So the way this indicator works is that at 9:30 a.m. Eastern at the CBOE SPX market open, you will get the levels on your chart for today's session. So starting off with the SPX bull bear key price level, which for today was 66.4361, and then you will have your main levels above and main levels below. So the main levels are R1 through R6, and main levels below are S1 through S6. So you also have optional midpoint levels that you can turn on, as well as quarter levels that you can turn on. And you can selectively turn on these levels above and below each main level. So in this case, today we have the midpoint level above the bull bear KPL and below the bull bear KPL, as well as the quarter level above the BBKPL and quarter level below the BBKPL. And we also have this quarter level below the S1 level and this midpoint level below the S1 level turned on as well, which we'll get to in a minute. One of the other things that is new about this version of this indicator, besides the addition of the quarter levels, is that we now have an expanded main levels that go all the way up to R10 and S10. So normally the default is just you will have R1 through R6 and S1 through S6. You can also turn off certain main levels if you prefer. If you just, for example, prefer just to see R1 through R3 and S1 through S3, then you can turn off these other levels manually in the user control panel. That's all that we go over in that and other aspects of the user control panel. That's in another video, which we will put in the description below. That's the setup and features video for this version of the indicator. So if you look at that video, it's about an hour long. It goes over all the features and all the setup and all the inputs in the user control panel. But for today's video, we're just going to go over a couple of points that are important to point out about the use of this indicator. Okay, so one of the other things, just to go over real quickly, that's in addition to this new version of the indicator, is that we have the CBOE SPX index pre-market high, which is PMH, pre-market low PML, YDH, which is yesterday's RTH session high, YDL, which is yesterday's RTH session low, and YDC, which is yesterday's RTH session close. Okay, so as I stated before, the levels come out at 9:30 a.m. at the market open. Your bull bear key price level is your main bull bear pivot for the session. So it serves a couple different purposes. One is to give you an overall bias of where price action is for today's session. If it's above the bull bear key price level, then it's bullish. If it's below, then it's bearish. However, in that context, the entries that you can take with this particular indicator are not limited to the bull bear key price level. In fact, there's no obligation to take any entries off of the bull bear key price level, and you can take them off of the other main levels, being R1 through R6, or in this case this indicator all the way up to R10, or the S levels. So that would be your levels that you can take bullish or bearish entries off of, depending on what price action is doing. And we're going to go over an example from today's session. So keep in mind that you do not have to trade at the open off of the bull bear key price level, that you can use the other levels instead, and if you prefer, you can just let the market shake out. And if your preference is that you want to take, for example, a long off of the S1 level or a short off of the R2 level, basically you can take a long or short off of any of these main levels. You do not have to confine your thinking just to the bull bear key price level for entries. So it really just depends on your style of trading. A lot of people like to trade the open, so the bull bear key price level is going to be most prevalent at the open as far as decision making. And so if you're the kind of trader who does like to trade the opening minutes of the session, then that would end probably 95+% of the sessions would be the level that you would either be taking your bullish or bearish entry off of. However, if you're the kind of trader that wants to be more selective in your entries and let the market open play out and let the market shake out, and then be more selective in your bullish or bearish entries, then that is what we're going to go over in this particular video using today's session as an example. Okay, so in this particular session, that we're waiting for the market to shake out under that scenario where we're not trading the open. We're waiting for the market to shake out and see what the price action is at one of the main levels. So not the midpoint levels or QL levels, but at the main levels, either the R levels above or the S levels below. So in this case, for today's session, we had a narrow trading range to start off with, and so we just have price seeking, and it gets down to the S1 level here. So the main thing that you want to keep in mind is that the process of entering a trade off of any one of these levels is as follows. If you have a cross above and close above, such as you have here, and you're looking for a long entry, then off of this S1 support level, then you have a cross back above and a close above here. So your entry would be here on this cross above and close above. Your tight stop loss on any long entry is going to be, regardless of what level, regardless of which level you're taking your long entry from, your tight stop loss is the first quarter level below the entry that you're taking, from that particular level. So on a long entry, it's the first quarter level below the level that you're taking the entry from, the main level. So S1 is a main level. Also S2 is a main level. S1 is the first quarter level below. That's this here, QL below S1, 66.2897. So that's your tight stop loss. Your standard stop loss is the first midpoint level below the main level that you're taking the entry from. So in this case, since it's S1, your standard stop loss is going to be the first one below, which is mid S1, S2. Okay? If you're taking a bearish entry off of any main level, again, these are the main levels here. The bull bear key price level is a main level, and all of these levels here are main levels as well. If you're taking a bearish entry off of any one of the main levels, Then it's the opposite. Your tight stop loss, if you were looking for a play below and entering off of this, would be the first quarter level above the S1. Okay, which we can go ahead and turn on. Okay, so that's the QL above. If you were taking a bearish play off of here, then you are taking a tight stop loss here, QL above the level. Your standard stop loss would be the first midpoint above the level that you're taking the entry from. In this case, it would be mid BBKPL S1. Okay, so in this case, since we're going down and you have this cross below, the conservative thing to do is to wait to see the reaction off of this one candle. Remember, we're on a 2-minute chart. So you could have taken this here. Okay, if you did, you would have gotten stopped out either here or here. The more conservative approach is to wait for a reaction and a follow-through. So that follow-through may give you a little bit, let's say that this was a bearish candle instead of the bullish candle that it was, and this was continuing down, and then you would take a, and you wanted to take a bearish entry, then your tight stop loss, as we said, was the QL above S1, and your standard stop loss is the mid BBKPL S1 because it's the first midpoint above. In this case, we got a close below, and remember, we're getting a sell-off here, so it's hitting the first important level below the bull bear key price level. So we're waiting for the reaction. The reaction is it's going back up to test it, and the next candle is a close above. So this would be your entry here. You could also wait for further confirmation for this entry here if you wanted to. But again, since your entry is based, your long entry here is based off of this level, then your tight stop loss is the first quarter level below, which is QL below S1, and your standard stop loss is the first midpoint level below, which in this case from S1 is mid S1, S2. So as you can see here in today's session, this particular trade worked out very well. So we had to move back up, basically testing the open here, which this is the open here. We had this wick above, and then we had the close here. So it's going back up to test this zone here of the opening. And if you're looking at what is your exit on this trade, your minimum exit that you're looking for is at least one level above. So one level above S1 is the bull bear key price level. That is the first main level above. That would be your minimum exit target for this trade. Your subsequent exit targets would be each half level above. So your next exit target would be 1.5 levels above S1, which is mid BBKPL R1. So this is one level to here. Here's a half level, so that's 1.5 levels above. Your next level above would be the R1 level. So this would make a full 2-level move, because we're starting here. This is one level, this is 1.5 levels, and this is 2 levels. The next level above would be your midpoint level here between R1 and R2. So we'll go ahead and turn that on. and now you have mid R1, R2. So that would be 2.5 levels above. So we have the move from here to here is 1 level, 1.5 levels, 2 levels, 2.5 levels, and finally here at R2, that would be 3 levels above your entry. Also keep in mind that we added these additional levels here for additional context on any given session. So here you have the pre-market high. Here you have yesterday's high. These can also be considered additional exits when you're going up, and additional levels that you need to be aware of, especially when there's areas of confluence as there is here with this R1 level. So this here would probably be the end of the road in most cases because it's challenging the pre-market high, R1, and then yesterday's RTH session high. As you can see today, it broke out above the YDH and the R1 and the PMH. So then it seeked out the next level, which is R2. But you do need to have a plan and a process as far as what you're looking for in your trades as far as exits. Are you the kind of trader that just is fine and satisfied with a 1 level move and that's fine with you? Or do you prefer 1.5 level or 2 level moves? Obviously, a 1 level move is going to occur more often. And remember, a 1 level move is still, in most cases, going to be approximately a 1 to 2 risk to reward ratio based on your half level stop loss, which would be your standard, and it would be a larger risk to reward ratio if you were using the tight stop loss. Another thing to keep in mind is that if you prefer to let the trade ride, then you need to adjust your stop loss as it hits each level increment. So when it hits your first level here, and if you're not the kind of trader that just wants to get out after the full 1 level move and you want to see if it's going to go up further and you want to ride it up, then you could either employ a trailing stop to trail it so many points behind, such as a half level behind, so it would keep trailing up, and in this case, if you were trailing a half level behind, as you can see here, then eventually you would have gotten stopped out up here. But a trailing stop can be used, or you can just adjust your fixed stop, and you can adjust your fixed stop in a couple different ways. One way is just moving it up in half level increments for every full level that it moves up. So in this case, when you moved up from here to the bull bear key price level, then you could put your new stop here, which will give you ensure that you will have a profit on the trade because it's above where you entered down here, and then keep moving it up for each full level that it moves up, move it up another half level. Or if you prefer just to move up in quarter level increments, and that you can also use the quarter level increments for that as well. It just really depends on which that you feel more comfortable with as far as how loose you would like to have your stop as you're adjusting it as the trade continues to move more in your favor. The other method is just to change the stop loss amount on your trade. So let's say, as an example, that your entry down here on this call, for example, if you took a 66.30 call, which is an at the money call closest to the S1 price of 66.31.90, then let's just say, as an example, this cost you $10. Okay, and let's say by the time it gets to here, it's say $16 or $17. Then another way that you could adjust the stop loss is to just then put your stop loss at break even, the price you paid it, which in this case was 10 in this example, or break even plus a profit padding. So let's say it was 16, 17 up here, then instead of making it a break even stop loss, you could go ahead and make the stop loss such as a number like 12. And that way, if price retraced and came back down and stopped you out, you would still have a profit on the trade. But as price keeps going up, then you can further adjust the stop loss. So let's say by the time it gets up to here, this is another 10 points up here. Let's say by the time it gets to here, it could be around, if it was 16, 17 here, it could be like 24, 25 here, or even 26. So at that point, you might want to go ahead and adjust the stop loss again to say 16, 17, 18, and then you keep adjusting it more as it goes up. So that would be a way of adjusting it as far as fixed adjustments as it goes up. If you just want to use the price of your option that you paid and then locking in specific profits instead of the other method, which is just adjusting your stop loss based on price action hitting retracing to a certain level. Or if using a trailing stop loss, then you can just decide how many points behind. So here, let's say if this was 16 or 17, at this point, then you could put a trailing stop loss, say, of 3 points behind, or 2 points behind, or 4 points behind. So if it's 16 and 17, and you put it at 4 points behind, then you're at 12 or 13, depending on whether it was 16 or 17 here, and then it would just keep trailing up 3-4 points behind. So it's really just up to you as to which method that you prefer. And another point that I would like to bring up is that when you're first using this indicator, it's a good idea for you to practice on it on a demo account, such as Thinkorswim with Charles Schwab. They have demo accounts that work very good on options as far as the real-time quotes and as far as the fills being fairly realistic on demo accounts. That's one thing that you need to make sure of if you're using a demo account, that the broker that you're using the demo account with to practice on has realistic fills on options. Some do not. One that does not is, for example, TradeStation does not have very realistic fills. Thinkorswim, on the other hand, their demo accounts are kind of a core feature of the Thinkorswim platform, and their fills are pretty realistic. So if you're going to use one, I would recommend that you use Thinkorswim for a practice account. And the point that I'm getting at is that anytime that you're using a new indicator, whether it is you've purchased an indicator from our company or you've purchased an indicator from a different company that's a different indicator, it is usually a very good practice to go ahead and use it on a practice demo account for at least 25 to 30 sessions. That turns out to be, say, 5 to 6 weeks. And what you can do in those practice sessions is you get used to using the indicator, you get used to using the process of the indicator, the full process, meaning entry decisions, managing your trade decisions, and exit decisions. And you need to experience using the indicator in all sorts of different market sessions and market scenarios. So over a 25 to 30 session period, you will experience gap up days, gap down days, you will experience high volatility days, you will experience days where we have mean reverting sessions, and then also sessions where we have a poke above and a poke below. A poke above meaning it's poking above yesterday's range, and a poke below, it's poking below yesterday's range. So the overall point is that you get to test out the indicator in your process of using the indicator over many different types of market scenarios in that a minimum 25 to 30 session practice period using a demo account. You just always want to make sure that if you are using a demo account, that when you're logging in, that you confirm that you are on the demo account. So the point is that by utilizing it for 25 to 30 sessions, you can get the process down in your mind where it's now becoming secondhand to you. You've experienced losses and gains, and you've experienced the process of using the indicator from entry, managing your trade, managing your stop losses after the trade is starting to go in your favor, and also managing your exits as well. And then also finding out for your style of trading what type of trader that you prefer to be. Do you prefer trading the opening few minutes and trading off the bull bear key price level, or do you prefer waiting for another price main level to hit and then taking trades off of those levels instead of the bull bear key price level? Or are you the type of trader that wants to do both? So all of that is very important to figure out whenever you're using an indicator, whether it's our indicator or another company's indicator. So I can't stress enough that you follow that suggestion and that you practice with it, and practice with it over at least 25 to 30 sessions before you consider starting to trade with it on your live real money account. And if you have any questions, you can email us at daytradinggps@gmail.com. If you have not purchased the indicator and you're interested in purchasing it, you can email us at daytradinggps@gmail.com to request a discount promo code, and we will send you a discount promo code that you can use to purchase the indicator at the link in the description, and which that link is www.whop.com/SPX indicator. So that's www.whop.com/XPX indicator, and that link is also in the description. So if you're interested, you can certainly email us any further questions about the indicator, and also request the promo code if you're ready to purchase it. All right, thank you again for taking the time to watch this video, and we wish you prosperity in all your future trading. Thank you.